Hi, I'm Brendan Mills and welcome to episode 8 of Finance Coach TV, you and your business's finance coach. So in the last two episodes we've looked at what an asset is of a business, and that's the first item or the first items that appear on your balance sheet. So in today's episode we're going to look at what liabilities are and examples of those that you'll find within your business. So the definition of a liability is pretty straightforward. It's made up of two components. It's an obligation to pay in the future. So you have a liability. There's an obligation, an onus on you and your business to pay somebody or some business or agency like a government, the taxman, in the future. The second part is the reason you have the liability is either the result of purchasing an asset or incurring an expense. So when you purchase the asset, you've purchased it on some sort of finance, or when you've incurred the expense, you haven't actually paid for it at that point in time. So for example, if you go to a grocery store, you pay for that expense straight away. But a lot of the time in businesses, a lot of those expenses you don't need to pay straight away. You can pay at a later date. So some examples of liabilities. Bank overdraft. So we want to try to avoid being in bank overdraft as much as we can, but the fact of the matter is that a lot of the businesses are in overdraft, sometimes of their own doing, sometimes, it's just the nature of their business. You just have to be in a position where you're in overdraft, and no matter how well an enterprise you run, you're going to be in overdraft. So that's where we owe money to the bank, but we use that as our bank account to fund our operations. Tax liabilities. There's a number of different tax liabilities, again, depending on where you are in the world. The main ones, though, are your income tax liabilities. So if you're running a company, that company has to pay tax. Your sales tax. So in Australia, you got your GST. For most of the world, it's called VAT, value-added tax. And in America, you've got your sales tax as well. So those tax liabilities where you receive and also pay those taxes, and then at the end of each month or each quarter, you have to pay an amount to the tax office or receive a refund. So those liabilities, you don't pay the taxman every single day. You actually pay them after a reporting period at the end of a certain period of time. Another example of a liability is an employee liability. So there's a number of employee liabilities. So for example, when you pay your wages, the employee doesn't get their whole salary in cash or in a check or transfer to the bank account. Some of that is taken out to pay for their tax. So one of those big liabilities is pay-as-you-go withholding or group tax, depending on what it's called in your part of the world, where the business has to pay at the end of the month, or in some bigger businesses at the end of the week, the tax that they've paid on behalf of their employees. So they pay those, they incur that liability. Another employee liability are things like superannuation, where you have to pay for people's retirement or their pensions in the future, and also holiday, sick leave, and other types of leave, such as long service leave. So they become liabilities. They're obligations that need to be paid into the future. Credit cards, pretty straightforward. So we've spent money on the credit card and we need to pay them back to the bank. So that's a liability. Bank loans. So a lot of businesses use loans to purchase a business or to fund a business through its operations. So again, they're a liability. They're an obligation that needs to be paid back into the future. And equipment finance. So equipment finance can take on a number of different shapes and forms. You've got chattel mortgages, HP liabilities, equipment loans, where you purchased, as the name suggests, a form of equipment or an asset to run your day-to-day operations within your business, and you pay that off generally on a monthly basis for either between 36 months and 60 months over that period of time. So they're the main types of liabilities. So they're the first two components of your balance sheet. You've got your assets and then you've got your liabilities. In the next episode, we're going to look at what the final part of your balance sheet is, which is your equity. So your takeaway action for today is look through the liabilities of your business, get a strong understanding of who your business owes money to, because it's really important. And look, it's important to take advantage of your liabilities, because it's a privilege not to have to pay things straight away. But it's also important to do the right thing by the person or the agency that you owe money to as well, to pay within the right period of time. So get a familiarity, try to say that properly, with your liabilities and understand how that shapes your balance sheet. So I look forward to seeing you in the next episode.